And good morning once again, options traders, and happy Wednesday, everybody. And I hope everybody has a fabulous Thanksgiving. So I wanted to post this last video before our break, and I think it's an important one, and it's about the cost and leverage misperceptions that so many traders fall into. And this is important for a couple of reasons. One, it's going to give you a different perspective on cost and leverage. And two, it's going to greatly emphasize the importance of education. Because if you're not able to see these nuances with options, you're going to either step into traps or miss opportunities. So let's go find out more about the cost and leverage misperceptions. And as always, before we do, please be sure to click like and subscribe. It goes a long way into promoting the channel and is so much appreciated. So first, remember what leverage is. When we're talking about financial leverage, it's really just a magnification in returns. So if the stock rises 10% and you have 2-to-1 leverage, you're going to end up with a 20% return. With 3-to-1 leverage, it would be a 30% return, and so on. Now, yes, that sounds like a great thing, but leverage is a double-edged sword. If the stock falls 10%, you're going to be down 20%. But the idea of leverage is just this magnification in return. So with that in mind, let's go take a look at index leverage. Now, it turns out that most of your indexes, such as the S&P 500, NASDAQ 100, are usually cheaper when compared in percentages. And this usually throws traders because they say, when I'm looking at the option prices, the index options are usually a lot more expensive. Well, they're a lot more expensive in dollar terms, but that's because the level of the indexes are relatively high. But the indexes are far less volatile, and that's really why they are less expensive. You see, it's certainly likely for a stock to go up 10% or fall 10% on good or bad news. We see that quite often. But you're never going to see that in an index. And that's because all of the stocks in there, at least in proportional to their weights, would have to be up 10% or more, because not all of them are going to be up 10%. Well, that would just be an incredibly unlikely event. And so the indexes are far harder to see big percentage moves. And because of that, their volatility is less, and therefore their options are less. But it's less in percentage terms. So to see that, let's go compare two at-the-money options. Now, at the time that I shot these slides, the S&P 500 90-day 39.65 call was trading for $120. The Tesla 90-day 170 call was $22. So remember, these are at the money. So the first question is, which of these is cheapest? Well, most traders say, well, that's a really easy question. 22 is less than 120, so the Tesla options are cheaper. All right, hold that thought. Second question, which of these has more leverage? And again, they'll point to the Tesla saying, well, it's cheaper. And so if Tesla rises 1 point or the S&P rises 1 point, a $1 increase on a base of 22 is bigger than a $1 increase on a base of 120. So you're going to get a bigger return by buying the Tesla option. So therefore, Tesla must have more leverage. Once again, makes perfect sense, but unfortunately, it's wrong. And to see why, we have to gain a new perspective on cost. What you really need to do is to consider options as a percentage of the underlying. So in that example, we saw the S&P had a cost of 120, the Tesla had a cost of 22. Well, if you can pay 120 for something that has a level or a value of 39.65, you're paying about 3% of the underlying. What about for Tesla? Well, you're paying 22 for something worth 170, and that actually turns out to be 13%. See, now we get a different perspective and realize that Tesla, in percentage terms, that these options are far more expensive than they are for the S&P 500. So now let's go take a look at a different perspective on the leverage. Once again, we saw the S&P 500 call trading for 120, and let's say that the index rises 10%. Well, 10% of 39.65 is 396.5, and that means, because this is an at-the-money option, that option's going to pick up $396.50. That would be the intrinsic value, and that's what you could close your call for. Well, if you paid $120 for it, we can just divide these out. $396.50 divided by 120 is a multiple of 3.3, and therefore an increase of 230%. Let's do the same thing for Tesla. The Tesla 90-day 170 call, remember, trading for 22. Now let's say that the stock rises 10%, which is 10% of 170 is 17 bucks. So you could close your call for 17. Well, you paid 22. That's a loss of 5 on 22, or a loss of 23%. So now, new perspective. The index up here rose 10%, Tesla rose 10%. On the index, you made 230%. On Tesla, you lost 23%. So this also shows why for a given percent, you're usually going to get a bigger return because there's more leverage on the index. Now, yes, as I said before, part of this is because it's going to be harder. It's going to be far more unlikely to see the index rise 10% compared to an individual stock. But this also gives you another reason for going out longer term with your options. But the thing that I want you to see here is the difference in the leverage. So let's take a look at these graphically. What we've got here are different increases in the underlying. So here we've got the stock or the index rising 5%, rising 10%, 15%, and on the vertical we have the percent returns. It's really what we just saw before, but instead of just looking at a 10% increase, we're looking at lots of different increases. So notice that if the underlying rises 5%, Tesla here is in black and the S&P is in red. You can see that the black is actually underwater. It's below zero. But the index is already starting to show some very good returns. If it rises 10%, this is Tesla rising 10%, and on the red line it's the S&P rising 10%, Tesla is still underwater. But the S&P is showing even more impressive returns. We're going to find that in this example, Tesla would break even at an increase of 13%. That would cause the index to have $22 of intrinsic value, which is what you paid for the option. But the index is showing an even bigger return. And finally, after we get up above 15%, Tesla's now starting to show some gains. But we can also see that this graph is fairly flat in black compared to that in red. And the reason for that is simple, is that the S&P 500 has far more leverage than does Tesla. And that will be true for most of your individual stocks. So again, this is not to say that buying options on individual stocks is wrong. You just have to understand, again, all of the nuances with the options and with the math behind it to make better decisions. I hear too many times where traders say, I want to buy the equity options because they're cheaper. And because they're cheaper, they have far more leverage. And you can see it's a very easy trap to fall into because in most cases, it's simply not true. And so for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.